All right. We are live once again with Exit Liquidity, brought to you by Blockmates. And we are here to give you the answers to your macro questions. And with me today, as always, my good buddy, Captain Rational. How are you doing today, sir?
I am very good on this Thursday. I look forward to the coming weeks and certainly the end of the year. Let's see where we are in these markets.
Yes, these markets are telling us things. Uh, would you agree? There
Oh,
are
incredible things.
as you are always looking for confluence in the markets. We are definitely seeing some consistent pointers, clues for the macro thinker, the
Confluence.
macro trader. Uh, like everything like you and I do tends to be thought of on more of a macro time scale. Um, you can't use macro information trying to trade on macro information on the daily is just that way lies madness. So um, you need to have a macro thesis and you start from there. And once you have a macro thesis, you can start to develop a framework for thinking about where we are, valuation wise relative to where we will be further out into the future. And when it comes to having a macro thesis, you have to have signposts that you look for along the way. And so you're obviously looking at the day-to-day information that comes in, but it's really just there to confirm your overall macro thesis and to make sure that it hasn't been invalidated. Um, and so far, I cannot say that our macro thesis has been invalidated. We only continue to be confirmed. And so I don't know. Well, let's get into the news because there has been some interesting news this week. The biggest piece of news, I think, is
Is there
right
a
here.
biggest? It's literally just back to back. Holy shit.
Well, Mario Draghi, and for those that don't know Mario Draghi, called for the EU to move towards a regular joint debt issuance. So let's talk about that real quick. Like, there are some interesting implications of this. One is when it comes to the euro, it in the eurozone, it has always been a it has always been
A
a
monetary union.
monetary union and a like separate fiscal states.
Fiscal
Like
disaster.
it would be like the equivalent of if the U.S. instead of having uh a federal budget, they had each state had its own budget that could run in deficits or not.
Well,
And
technically we do as well.
well, the states technically are not allowed to run a deficit. I mean, they
Ah,
have ways around that, but the states are technically not allowed to run a deficit. Only the federal government can run a deficit. Um, and so there are differences between a unified fiscal and monetary
monetary.
union and a union of
Euro.
states where each state can kind of control its own debt issuance, and it was always seen as kind of a bold experiment, and it was always referred to as the Eurozone experiment. And I mean, so far it hasn't failed. However, the fact that they are now considering uh, moving more down the line towards a fiscal union is interesting, and has some very interesting um, consequences.
It's a monumental
So
structural change.
during COVID, though, the ECB did issue some debt, like uh, like some of their own debt, and so, or the Eurozone did issue like their own debt. The fixed income like whole space in Europe is kind of interesting because you had German bonds, which were always like top tier collateral, like so good. It was like the gold of repo collateral in Europe. Nobody like it would suffer from like the Gresham's law sort of because they didn't issue a lot of it because Germany had a constitutional mandate to basically balance their budget, which is now becoming highly stressed, trying to get that done, and it's forcing them to do things that, I mean, that may not last much longer because it's not feasible. Or Germany is. This is really, Mario Draghi speaking on behalf of Germany, who is trying to find a way out of that constitutional mandate. But it's funny because the most commonly used debt, if I recall correctly, in Europe is actually the Italian bonds, not and I'm trying to recall the name of them, but the Italian bonds are plentiful because they issued tons of debt. And so there was a lot of collateral out there to lend against, whereas the bonds like
We're constrained.
would trade. I mean, they would actually trade below their interest rate regularly just because there was so little of them and they were seen as being the highest quality collateral. And so you get this sort of Gresham's law that the best kind of money disappears and the worst form of money is the one that circulates. And hence Italian bonds being the more commonly used silver coinage versus the bonds of the German Bund. So this whole going towards a kind of more unified thing where they're going to issue debt as a European Union has huge implications. And I kind of wonder if this may actually make the euro debt markets stronger and make the euro more viable as a global collateral.
Well, we
Because
wonder these things, but I often think in terms of, since we don't know anything and all we can do is speculate with regard to the potentiality of these types of changes occurring, we can always come to the conclusion that this is an extraordinary structural change. And
indeed,
structural changes like this do two things. One, in the short term, the path is likely volatility as everyone tries to figure out what the heck to do and how to position. And the destination is some sort of more stabilized situation, which would lead to the proliferation of currency and debt and collateral, which implies a
yeah,
degree of I was literally just going to say the word prosperity.
Yeah. And I think so. That's more of a long-term thought I have, though, because in the short term, the reason they're doing this is so that they can issue more currency now, issue more debt, pull money forward in time. And that's why gold, I mean, the gold chart has taken off, and we'll get into that. But like, they're looking for ways, because right now, because of the what I alluded to earlier, that the countries that had the worst kind of fiscal position, their debt was the ones that like actually was the most heavily, had the most volume associated with it. And having this sort of European debt issuance collectively, what that does is it kind of allows for issuance of debt that kind of strikes the middle of the fiscal responsibility window, rather than having to rely on these over indebted countries like Italy and Spain and their debt to try to buoy this pulling of money forward, because Germany is constrained constitutionally from issuing more. And so they need stimulus because the European economy is rolling over. You need energy. Germany has, for whatever reason, shut down all their nuclear plans. I think I know the reason. I think it has to do with grassroots or astroturfed, really. Influenced by Russia to get them completely reliant on Russian natural gas. And then once the Nord Stream pipeline blew up, and the Russia-Ukraine war happened, now they're up a creek without a paddle. And as always, they're going to be just using France's nuclear power to offset all of their base load. Meanwhile, they go, look at all this wind and solar we have, but there's a difference between base load and peak load, and you cannot run a power grid off of just wind and solar. Like, it does not work. And the notion that they think they can get away with it, you can run off natural gas, but if you don't have any of that, then you're going to have a bad time. So energy makes the world go round. Europe is now lacking in energy because of these poor decisions made by Germany. Germany's economy is in the toilet, and Germany has been the one that has been dragging Europe up over the years and helping to buoy some of these weaker players like Greece and Italy. And now they can't. And their energy costs are sky high relative to, their production capacity is in the toilet.
Productivity's down.
Productivity's down. Yep. There's demand is in the toilet for cars because everybody overbuilt. Everybody overbuilt when the COVID shock hit, because nobody could buy cars. Like, the prices went too high. Nobody could buy cars. And then because of the chip shortage. And then all of a sudden, all the chips came in. There was a huge release of a bunch of cars that had all been kind of sitting off market because they didn't really shut down the factories during that time. And then that brought all the prices way down. And now, nobody has the money to buy because of the high interest rates on the global stage. And so demand is rolling over, especially in the car market. Like, look at EVs. Like, look at how cheap some of these like EVs have gotten. Like,
even the Colorado. Wait, was it Washington or Colorado? I saw Tesla with the incentives down at like $60 a month.
That's crazy. And like I've seen like you can get like the what is it, the Audi e-tron GT. I've seen those going for like 50K now.
They're
Like
giving them away.
with like yeah, I mean like it's crazy. So I think demand has been seriously hampered by high interest rates and keeping them where we have. Because and in the US especially, like the car market is the only place where Americans are interest rate sensitive. Like really. I mean, and housing if you don't already have a house. But
But
if
statistically,
you're locked
most
into a house, it doesn't matter. If I don't care what interest rates could go to 50%. It doesn't change the fact that like my mortgage was locked in 2021 and
that's
I'm
right.
sitting pretty with fantastic optionality. So it's a Americans in
Conundrum.
general are less interest rate sensitive than those around us. The
Well, look at
Canadians,
Canada. The whole
yeah, I
system
was
in
just gonna,
Canada is variable rate.
yes, and so they have been getting killed, and their real estate prices are actually correcting, which isn't necessarily a good thing if you want a giant property bubble to make all your rich people richer. But
So the problem is
that's
the
why
property.
in the U.S. the housing prices have been very, very slow to come down. And the reason is people like me are locked into these low rate mortgages. And I have lost the optionality to move out of that situation because it just wouldn't make financial sense for me to move to a different house and get a new mortgage with a much, much, much higher rate, and so supply has been locked off the market, and you don't get that price level correction. Now, what's going to happen as the Fed lowers interest rates, as they come down, they're going to get closer and closer to the average interest rate on housing, which I believe, if I remember right, is somewhere around 4.5%. Is about the average. 4.5% is about the average interest rate on a mortgage. As we get closer to that, you're going to see supply coming onto the market
Oof. Oof.
as people suddenly are no longer locked in and don't have the same lock-in that they did before.
Yeah.
And when that happens, that is when you will see the correction in pricing in real estate.
Oh my
And
goodness, it's complicated. Look at Florida. It is an
I
absolute
mean, Florida is
fascinating.
already having, like, Florida is just the canary in the coal mine because Florida has some other issues going on regarding the
The
insurance
condos,
rates and then the
the
aftermath of,
assessments.
yeah,
It's
the
insane, dude. There's $1.1 million apartments are selling for 400,000 or 500,000.
yeah. And
This
then
is like
there's
a
also
200,000
a lot of that I think also has to do with the big building
policy.
collapse in
It's
Miami.
all because of that.
Yeah, and so when giant apartment buildings collapse and because of like a sinkhole underneath the sand or whatever, like suddenly people start asking questions about, hey, are these buildings up to code? Like, has anybody looked at what's going on underneath these things and how do we bring these
Not in
things up?
30 years. This is,
Yeah,
this
I
is
mean,
all 1990s, 1980s, and oh
yeah,
dear, the
yeah,
dilapidated.
yes, absolutely.
Especially the stuff on
And
the coast on A1A, all the old
yeah,
stuff.
yep. So Florida's got its own problems with all the like, I mean, they've been getting hit by hurricanes and all sorts of stuff.
Oh, we
Um,
always do.
Yeah, you always
You
do.
know what they
But
do? I think about it a lot. Like a lot, so many of the central, the older part of the neighborhoods down here weren't structurally built. They were just built. But what you see in a lot of communities, especially the newer communities, they're all built around a reservoir, uh, a man-made lake. And they do that for a very interesting reason because when there is potential rainfall, significant hurricane level
yeah.
rainfall, you empty the lake and you design the home structures around it to with sewage and drainage into the lake. And you're pumping the water basically into the Everglades. So you literally have millions of gallons of empty space in the lake that you're pumping out prior to the hurricane that allow complete drain off of all the property, the surrounding properties. Very interesting construction. So we're not too hot.
So when did that
Very
start? That started in
uh,
like the 90s.
late '90s, 2000s.
Okay.
Anything before that is a complexity.
Yeah, that's very interesting. I mean, I'm sure that that came from a I bet that lowers their insurance relative to those that don't have such features and amenities in their
Also,
properties.
flooding. In Florida, flooding is massive, but there's no flooding. Like you literally have floods. You have flood zones, and then you have optimized property that's not a flood zone.
Got it. Huh. That is very interesting.
Engineering, yeah.
But real estate, to your point, is a very like
Spotty.
spotty market. It is not a monolith. And so I think the places where you're seeing it the most are the places where you had the Airbnbs, where people were levering property in order to get cash flows. And those places especially are where people puked up the property once interest rates went up and they could not extend and pretend. They were forced to liquidate those properties. And so that, like I said, is sort of the canary in the coal mine. What's going to be interesting is what's going to happen when the rest of the housing market has to deal with these supply issues, and you're going into a demographic that is, I don't know. We'll see if the demand is there, because there probably is quite a bit of pent up demand for housing from Gen Z as far as housing is concerned, who've been trapped out of the market because after you account for interest rates, it's housing has never been more expensive because we
You know what I think about
refuse.
often? I think about so often all these nuances we talk about with regard to housing, commercial real estate, residential, obviously. But all those economists at the Fed, this is what they study, and they're forward looking. So I so think in terms of what are they planning? What are they? What are the policies? How do you mitigate? What do you do? And I'm in the camp of they're not dumb. They're very smart. And I'm in the camp of this is a completely managed financial system. And clearly from the federal level, it's to protect solvency. I mean, that's the
Yes,
overarching
because the
mandate.
banking system relies heavily on mortgage debt, and the US government backs, by way of agency securities, agency mortgage backed securities through Ginnie Mae and other GSEs, government sponsored entities. They back those mortgages. So the liability is not only on the banks themselves,
It's a
but
federal question.
it's on the federal government. And so not only do they have to protect the solvency of their banking system, which they cannot have a massive correction in pricing, and without bleeding it off slowly enough that, like, you would have to actually keep interest rates high for quite a long time, I think, in order to bleed that off slowly enough. to where, because if people aren't taking out new loans and are paying down debt, what that does is it actually makes those loans more solvent, right? Because as you pay it down, the loan to value, comes down. And so you're more and more solvent. So I think that was you got a giant debt bubble, you hold interest rates high, you prevent there from being more local debt created within the confines of the United States. And as that happens, it slowly, you pay down debt, you pay down debt, you pay down debt. But when you pay
look at
down
residentials. Residentials are in a debt to equity situation nowhere near 2008. They're frankly in a healthy territory.
Oh yeah. Oh, they're the healthiest like they've ever been. I mean, what is it? Something like, I think it was like 40 or 60% of mortgages are paid off. Because the boomers have pretty much paid off all their houses, or at least come close. Not all the boomers, obviously, but like there's a lot of people that took advantage of those low interest rates. And at low interest rates, you actually pay down the principal faster. And so money is destroyed more quickly at low interest rates than it is at high interest rates, because it takes longer. That asset is worth more on the asset side of the bank balance sheet. And then on the liability side of the person who's borrowing the money, it takes you longer at the higher interest rate, or at least you have to pay more money, and more of that goes to profit and to cash flow that re-enters the economy rather than just shrinking the balance sheet of the bank, which was expanded to issue the loan. And so that is one of the reasons why you had such tepid growth in the following the GFC, is that when you lower interest rates domestically,
it's capital destructive quicker.
It is capital destructive because everybody can refinance, extend, and pretend they can refinance their loans, and then it destroys dollars. It pulls money away from the bank balance sheets, because as people get money, they give it to the bank. That shrinks their balance sheet. So they have to be constantly issuing just to keep their balance sheet the same. But you get like a sort of Cantillon effect problem that happens where nobody wants to issue debt at 0.25%. And so and that's the thing that breaks.
Just screaming about that. I've been screaming about that, especially in offshore banking. That's going to be weird this time, dude.
Yes, it is. I mean, and this is the whole thing that like boggles my mind with this whole 1950s econ textbook bullshit that I learned when I took macroeconomics in college. They literally tell you like, oh, well, if you lower interest rates, then all else is not equal. But if all else equal, then the demand for loans will increase. But it doesn't work that way.
This is the opposite criteria. It's the demand to loan.
Right, exactly. You have to look at the supply and the demand. And at low interest rates, the supply goes down super low, and it's just bankers and their buddies lending to each other. And then you get crazy stagnation. Inequality.
Hence where we are.
And so that brings us. That was a very, very long discussion that took a lot of twists and turns for one news item. We haven't even gotten to the charts yet, so let's keep this thing moving. Some other
Don't
interesting things.
worry. My introductions usually take a half an hour as well. My opening monologues. True. Folks
So,
know that.
so China has been absolutely rolling over. Like because they have blown their property bubble up in ways that make the
The
global
GFC couldn't.
financial crisis look like a
Tepid.
miniaturized model. Like I'm in the middle of reading this really interesting book, and by reading I mean listening to, because I do mostly audiobooks these days. But it's called The Great Wall of Debt, or China's Great Wall of Debt, and very good book. Very interesting to kind of hear about how that works. But anyway, the VCs, like nobody is founding companies in China anymore. It went from 2018 51,300 new startups to 1,200 so far this year. Like it has fallen off of a cliff, and a lot of that has to do with foreign direct investment in China. All of the saber rattling that she's been doing about, trying to, expand their control over the South China Sea and the Taiwan stuff, or
Who
taking
wants to
over the
invest?
Philippines. I mean, they've basically aligned themselves with Russia and the rest of the BRICS, and they have tried, and some of the other outcasts of the world economy, the Argentinians that have defaulted on their debt so many times I can't even remember, in the last 100 years. So it's like all the worst run economies in the world have decided to form a super band, and that is the BRICS. And so here's China's real estate market, on which everything in China is predicated. Like all
Is
of the
the
banks,
collateral.
this is the collateral that is running all the banks in China. And so, like, it is at lows that have not been seen since 2008, when people were already saying that China's housing market was in a huge bubble. And then they blew it up for another, decade and a half to biblical proportions. And so this thing deflating, and this for real is a macro headwind. And this is the real part of the real Operation Extend and Pretend, because at some point this bubble bursts for real. Like they've been able to stave this off, but
Yeah, by buying everything and bailing it all out. I don't think
but
it's a
the
headwind
central
anymore.
bank has not been bailing it out, and that's the problem, honestly.
They're going to go to direct payments to citizens. That's what they always do.
Oh, they
That's what
are, and
we
that's
did.
probably why they have the CDBC, is so that they can eventually just devalue their currency in order to save the day. But the amount of collateral damage globally that will take
Mm.
place when this dying star implodes is going to be massive.
Yeah, but there's the dying is to the upside with regard to currency supply and the devaluation of the currency. But
Yes,
that's
they will be devaluing their currency, and they will be devaluing their currency hard. And it will, I mean, it may not impact the US economy because as much, and part of this is the flip side of, for every action that policymakers take, there is an equal and opposite reaction. And the policy action of creating capital controls to prevent money from leaving your country, the opposite reaction is people don't want to put money in your country, unless you can like actually create growth that makes that risk worthwhile. And right now they have not been able to prove that to the economy, and that is why this particular Ponzi is starting to collapse, and has been basically since COVID. You've seen the property values just plummet and plummet and plummet, and so much of this debt is hidden in these little tiny entities that are kind of off the bank balance sheets. But then the governments themselves, local governments, not the central government, the local governments, especially in some of the less populous areas, they're who the CCP members that ran those particular areas, they were graded basically on how much GDP they could create. And so they would do whatever it took and look the other way on whatever banking malfeasance was taking place in order to hit those GDP numbers. And so whenever you look at GDP numbers coming out of China, you have to remember that in China, GDP is an output, or is an input, not an output. Like they would decide we want 10% of 10% GDP this year, and then they would just manufacture. They would just extend the balance sheets of whatever financial entities they had, shadow bank or otherwise, and they'd hit that target. It wasn't because, and just like any other Ponzi, like an Ohm Fork or whatever, like people would see that growth and they would go, oh man, I got to get in there. That's where all the economy is booming. That's, we're all going to be speaking Mandarin soon. And, I remember hearing that crap, 20 years ago, 10 years ago, that like, oh man, pretty soon China's going to take over the world. But like really their economy is in the process of imploding. And the central bank thus far has not been willing to take any of that debt really onto their balance sheet. It is still sitting in these dark places out in the shadow realm.
Yeah, but that's the point.
And it's that is the point. It is not marked.
It's like QE. Aside from that, it's also QE in the U.S. Everyone says, when's QE coming back? They don't need QE to come back. QE is a policy disaster from an optics standpoint. All they need is a subsidiary, a private corporation that has, what's it called? A central bank account? Or
master account. Yeah.
That's it. And they're able to facilitate all policy indirectly vis-a-vis. That's it.
Yeah.
This is all free. You got to take it to the disgusting level to understand the system.
Yeah. And so one of the things so they built all this infrastructure, right? Like they spent all this money, they built all this infrastructure, and infrastructure costs money to maintain. And they have a collapsing population. There are half as many 5-year-olds as 10-year-olds.
Oh, demographics. Ooh.
Like the demographics are absolutely god awful. And they have this enormous amount of debt that is hidden off in the shadows. And who is going to maintain this massive manufacturing? And like they've built roads and bridges to nowhere and cities that are ghost towns, and all this stuff needs to be maintained. It was incredible amounts of malinvestment, like just insane proportions of malinvestment And then at some point, you're going to have to decide what of those investments is worth maintaining and what isn't. Like, you hear all these stories in this narrative about like, oh, look at China. They can build a highway in a day and build like entire cities overnight, and we can't even maintain our bridges. And maybe there's like some underlying truth to the fact that like we're bad at maintaining our infrastructure. But I guarantee you they will be worse when the infrastructure needs to be maintained. When everything you have is brand spanking new, you don't need to worry about maintenance.
20 years, 30 years down the line.
Yes, exactly. Give it 20 years. Give it 20 years. And you will see that, like, not only by then will all of the people that have been run, like, with all the know-how, have, maybe died since, like,
Aged out of humanity.
aged out of the economy. Yeah. You're
Humanity.
going to have a much, 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 much smaller amount of people that are able to maintain that. And meanwhile, those same people are going to be getting absolutely ravaged in fiscal dominance as China is forced to devalue their currencies. And this is why things like gold, this is why China is hoarding gold right now. They have to do this stuff before things get marked to market. That's why all these central banks, and you've seen this, this is why gold is going through the roof, because everybody knows a currency deval is coming. And
wow, holy shit. Back up to 53. Talk about a rat. You did say there was, I didn't expect to see that kind of rally today. That's all-time high.
Is it really? On the SPX?
Yeah, it's fresh all-time high on gold.
Oh, on gold. Yeah.
Wow.
Yeah, and that's why. If I were a central bank and I were expecting to devalue the shit out of my currency, wouldn't I want to buy a bunch of gold before I do it so that I can, have something that isn't devalued before I do that? I mean, buy gold, buy Bitcoin, buy all of the things. And here's another bullish thing about Bitcoin and capital controls is that, like, having Bitcoin in a world of capital controls gives you a way around those capital controls. In China, the reason that their property values got up to here was because the capital controls would not let the money leave the country. And so it's got to go somewhere. People used to talk about TINA in regards to the stock market. There is no alternative. You have to invest in the stock market because there is no alternative. We're doing the same thing in a lot of ways, but it's all the world's economy pointed at the stock market rather than just the property market in China.
Isolation.
And so their capital controls partially caused this bubble, and this bursting, people are running for the hills. Like, people are putting gold on ships and like shipping it out of the country. And
I've seen weird stories.
Yeah, there's just crazy stuff going on. So additionally, HSBC trying to issue all this debt on contingent convertible securities.
And look,
I don't know that I'm willing. Yeah, I don't know that I would be buying those. I actually don't know.
No, actually, it says
it does say
US.
It does say US dollars. So
yes.
Again,
how are they issuing US dollar debt? It's the way banks work.
They have lots of dollar assets.
Therefore, they can create liabilities based on those dollar assets, which are dollars.
But this is actually the opposite, though. This is them creating a dollar security in order to get dollars. This is the other way around. These
they're
are them
raising dollars.
issuing, they're raising dollars using contingent convertible debt. So this is the opposite problem. They are raising money because they need capital. And when
And
you're
look at the
bank,
interest rates. Wow.
I know.
They're paying a
And
premium.
well, contingent convertible, that usually means that like something has to happen in order like it's kind of an if then statement. Like if you know this is met, then
Contingent.
you're gonna get some amount of equity or whatever in the future. Or it really comes down to the whoop, that wasn't really what I meant to do. Habit. I see that number growing. I have to hit the button. All right. So enough on China. US federal budget balance actual.
Boom. Blowout.
Yeah, blows it out. Negative 380 billion on a forecast of 292. Previously 244 billion. So not
That's
great.
huge.
That is a big blowout, and that is again issuing debt, issuing lots of US debt.
It's over a 50% blowout of previous.
Yeah, absolutely. And some of that maybe raising money in the event of some sort of, because after the election, there's, they've pushed off the debt ceiling thing to 2025. So there's also some thinking ahead as far as that's concerned, right? Because that debt ceiling battle, it is entirely dependent upon control of the Congress. So if one party controls, both houses and the executive, you're not going to see a debt ceiling battle. But if there is any sort of, if you don't have complete control,
politics, my God,
then the debt ceiling battle begins. And so that debt ceiling battle forces them to drain down the TGA while they do all their horse trading and whatever. And that's when you see dollar strength start to take off.
Wasn't there a gilded age in this country where politicians were scholars? I mean, clearly the framers of the Constitution were scholars, and I mean highly intellectual with extreme
they were
critical
philosophers.
capacity.
They were straight
lawyers. I mean, it's been downhill. It's just like it's turned into American Idol. No, oh my God.
I mean, we have created a society built on debt, and we have created a monetary system that requires the U.S. to run deficits. We are required to run a deficit in order to sustain the demand for dollars globally, in order to assert soft power across our borders. Like the reason that we can put Iran in a box economically, not saying that that's a good thing, but that's what we do. And the reason that we are able to do that is because we have a dollar currency system that everyone in the world needs dollars to get oil. Everybody needs oil. Everyone needs energy. And we can use our dollar rail system in order to exert soft power. We can take people out of that system. We can cut them off in a form of capital controls into your country.
It's such a perverted system.
And so in order to maintain that soft power, we need to make sure that everybody's debt stays denominated in dollars. And in order to do that, anybody can make debt overseas. We don't need the permission. Like a German bank can make debt denominated in dollars. HSBC can make debt denominated in dollars, but they don't need the US's permission to do that. And so what happens is you get a creation of dollar denominated debt that requires dollars to service. Where are they going to get those dollars? They have to come from somewhere. And if they aren't coming from the US itself by way of trade, now they have to come from somewhere else. And that somewhere else is the safety valve, deficit spending.
Or just other dollar-denominated debt, which creates
dollar denominated debt. Yes, right.
So there is dollars. It's all is like it's 5 and change trillion M0, and Mike Howard talks in terms of 270 plus trillion. You're talking like 95+% of dollars on the planet are in dollars. It's just a fascinating construct these people created. I like this, Mr. Unity.
Yes. So is the only reason the U.S. debt treasuries are the best is because all others are just worse garbage junk, the best of the worst, so to speak. So it's because everybody has debt denominated in dollars. Debt in dollars equals demand for dollars. I will not let the dollar go to zero because I still owe money on my house. So I will buy those dollars to pay off my house if they get cheap enough, and so
dollar debt's through the roof,
and dollar debt is up only. Dollar denominated
let's talk about
up only.
There's you use a word there that's very important psychologically, best. So yes, relative, best is relative. It's all shit. These are shit investments. So that's another story.
Yes.
Remember that one.
Yeah, that's why people like Lynn Alden have been banging the drum of nothing stops this train. Like these governments have to push gold higher. They have to push commodities higher. They have to push energy higher eventually. They've been doing everything in their power to manipulate oil, manipulate like uranium, all the things that are needed to keep the economy going, natural gas, all these things.
A managed financial system.
Yes. So
it's nothing.
I mean,
nothing organic left.
No, there is. It's just, I mean, I think crypto is about as organic. Crypto is about as organic as it gets. But it is a byproduct of the Eurodollar system, basically. So
well said.
It is a subset of the offshore dollar system, and it is one that they can't control, and they don't have the same level of degree of soft power over it, and therefore those that understand soft power in the government don't like it. Those that are interested in
which government? I love saying that. Which government? Because who gives a shit about a particular government?
This is true, but the U.S. government in particular has done everything they can to fight off this because they like that soft power. And
Bitcoin's at 57.5. They have no power here.
You have no power here. Yeah. So last bit of news here. We're almost an hour deep into here and just getting through the news. Haven't even gotten to charts yet, but IPOs have fallen off a cliff. Nobody wants to issue an IPO right now, which is fascinating because the SPY is at almost all-time highs.
Remarkable.
I think, that is very interesting as well. Global liquidity, by those who measure it, is on the uptrend. So that explains some of what Bitcoin's price action has been.
The chart is insane, dude. I mean,
Okay,
it is nothing like history. It's so remarkable, its situation.
yeah, actually, this doesn't work very good. Let's see. I'm going to minimize this back down again. But there, so this is a website made by a couple guys,
Yeah,
Macro Dispatch on Twitter, and
share it then.
Oh, crap. Yep. Sorry. Doot, doot. So, macrodispatch.com/stir. So this is looking at money markets. And we talked about this a little bit last week, but the situation has continued to deteriorate a bit here. And this is looking at money markets. This is fixed income products. This is the money that makes the world go round. The US dollar markets, looking at money markets worldwide. And a crazy thing happened back at the beginning of August when you started seeing the yen carry trade unwind. You see, actually, it started a little before that. You see tri-party repo, and there's a whole thread on this that Conks did. So if you don't follow Concodenomics, go check that thread out. But basically, you see these orange lines here. These are supposed to be the floor and the ceiling of the federal floor and ceiling system. Like,
is that so far?
So the top one is the standing repo facility, which is basically, if it gets high enough, the Fed will lend to you against your collateral at this particular rate. So it's supposed to be, there's no reason why you would ever go above this unless you don't have access to it. Because not everyone does have access to the standing repo facility. But they've tried to extend that through swap lines and stuff to make it so that just about everybody can get reasonably close to the standing repo facility levels. That's at 550 basis points. And then you have the RRP facility, which is the reverse repo facility. Between these two lines, it's supposed to be more or less the road. And they want you to stay on the road. They want these money markets to stay on the road. And if they start going off the road, something weird is going on in the money markets. And
so look at that. Do the tri-party. That's the meat and potatoes of everything.
This is the tri-party repo value right here. And then it dives down well below. It's down to 524 basis points.
So someone is lending at a discount.
Yeah, as of August 16th. And that is not very recent. Why did the data stop? That is sus as hell. Hold on a second. So let's go here.
Even lower.
So, okay. So there is still data coming from the OFR. Something may just be wrong with the data hasn't been pulled recently on their website. But tri-party repo down to 519 basis points. Now, keep in mind the FOMC is coming up the 17th and 18th of this month, where the Fed is expected to lower probably 25 basis points. I would expect 25, I guess, at this point, based on what we know. I don't see a reason for them to do anything drastic at this point. And the risk of going too hard too fast is that by lowering 50, you're now pushing more money towards EMs while the dollar is already weakening very quickly. And it's going to cause, although maybe that's what they want. But I think they would want to do this in a fairly controlled fashion, because with the yen carry trade unwinding and various other carry trades unwinding, that, as a matter of fact,
like the stock market.
Yeah, they don't want to move too quickly, lest they blow something up the way Japan did when they accidentally raised too quickly.
You catch that equation, folks? You lower too quickly, which is what history says. They do a 50 basis point cut. Now, all that leverage that has gone into the S&P and NASDAQ, they get caught off guard, because now they're expecting the dollar to depreciate. The dollar will depreciate in a lowering interest rate environment. Foreign currencies will appreciate. Therefore, you're going to have to pay back more capital after you sell your U.S. equities.
Yes. And hold on one second. I'm going to pull up the
so that's why historically equity markets roll over when the Fed starts to cut.
All right. So as of today, looks like everybody agrees with what I just said. I hadn't looked at this thing in weeks, so but it's looking like only showing a 15% chance of a 50 basis point cut right now. So yeah, 85% chance. And honestly, the Fed watches this stuff, and when it starts reading things that they don't want it to read, they start leaking stuff to the press. You start seeing op-eds by Nick at the Wall Street Journal, the Fed Whisperer, telling people, hey, because they're in a blackout period, I believe, right now, because the blackout period, Fed officials aren't allowed to talk to the press for a certain amount of time. I can't remember the exact time frame. I think it's 2 weeks, but don't quote me on that. Prior to the FOMC meeting. And so if they want to change market expectations, because they don't want to surprise the market, they literally don't want to surprise the market, because that can create dislocations
Massive
in market functioning, that then they would have to perhaps feel the need to step in and fix, and they don't want to have to do that. So what they do is you just look at all the op-eds on Bloomberg and FT and all the stuff coming out of the the different big banks, the Goldman Sachs of the world. You can get a feel for what they actually intend on doing. Unless they're trying to shock and awe the market, they are not going to want to catch the market off guard. And so,
which means it's such a short-term inspection. It's such an irrelevant. It's so irrelevant in the decision-making process for rate cuts. The market's telling you already what it expects.
Well, yes, and this is a great opportunity to get to some charts, because there's this idea that the Fed controls interest rates, and
to
some extent they have control over the short-term interest rates. Now, the things they don't have control over, though, are the longer-term interest rates. And so look at gold right there. That just happens to be the chart I had pulled up. But I wanted to take a look here. Look at the 2-year. Look at the 2-year note and what it has done.
Insane.
It has fallen off a cliff. This is not the Fed. what they like to do, you know, that trick where you like put like a magnet under the table and then you put something metallic on the top of the table and you move it around underneath the table and you go, look, I'm making this thing move. I'm making it, and you know, you mess with your kids or whatever, and
That's
and
fun.
like I'm using the force. That is the Fed with interest rates, especially longer term ones. They're making it look like they're moving the markets, and to some extent they do. I'm not saying that they have no impact on the forward looking aspect of rates. However, the fact that the 2-year note is trading at 3.67 right now tells you that this is where people expect rates to be roughly 2 years from now. And we are a long ways from there.
Oh my God.
Now, I will say that there are absolutely things that impact the price of treasuries, the price of derivatives, the price of hedges, that aren't related to the Fed. Because like some people like to point to like, oh, look at the SOFR futures and all this stuff, and go, look, everybody's predicting there's going to be like 6 rate cuts the next year or whatever. You have to keep in mind that people and have positioning in the market, and positioning drives everything. If everybody's on one side, then the price is going to move to the other. And the other thing is, if you're on one side of the market in the spot market, you need to be hedged in the opposite direction on the other. So, or you're taking on risk. And so you've got to keep in mind that like sometimes the pricing that people are seeing, and they quote, you'll see this stuff on FinTwit all the time, people talking about how many interest rate cuts are priced in, and they have been priced in for a long time now.
Already in the bond market.
But well, typically in the futures market is what they're looking at. And you have to understand that like a lot of that is hedging, especially after so many banks got absolutely rocked when interest rates went up unexpectedly. They got absolutely slaughtered. So people have to hedge the raising of rates. And so, you know, you have to, the spot and the derivatives, that you have to look at the entire picture and see what the positioning actually is. Because just because Bitcoin, and you see this in Bitcoin too, just because Bitcoin spot prices sell off, you can replace that exposure by buying derivatives. So there can be arbitrages that, or maybe somebody wants to retain that Bitcoin exposure or gold exposure. And so what they do is they sell off all their spot. They have lots of cash, and then they buy a leveraged position that will cover the upside in case they're incorrect in their positioning. That way they are hedged. Together, those form a complete picture of market positioning. And unless you have both sides, you don't know whether the market is net long or net short. You cannot just, it's like the Fed looking at interest rate demand and not supply, you know, for loans. If you're looking at just spot or just derivatives, you are not seeing the full picture.
Oh, look at Tri-Party. the supply of loans. Clearly, the supply is great. The people,
Yes.
actors
So
using tri-party are either forced or opportunistically lending at a lower rate than the market expectation or the market policy
yep.
to take advantage of either balancing their balance sheet or forward looking on the interest rate path.
Yes, correct. There it is in order for that tri-party, which if you dig into what part of the tri-party is dragging those down, it is basically foreign collateral that is being used, presumably largely yen. But it could be a lot of different things. It could be pesos, it could be any number of various carry trades that are expressing themselves. And this may just be a way of expressing a bet on dollar weakness going forward.
It's not
And
like the DXY screams dollar weakness is coming.
so let's take a look at the good old DXY at the very tippity top here.
I
So
mean, it's only talking about primarily the two most significant allies, Europe, the entirety of Europe, and Japan. Oh my God. This
so
is such a cool
we
chart.
have bounced off support here, though. We have
200.
bounced off
An
support.
expression of support is an expression of weakness. Support is a defensive position. That's just something I always state.
That's fair. But we have to see it break through support before
Mhm.
our
Confluence, yes.
confluence is confirmed. And
Yes.
so
How many
and
times has it hit
and
that
here's
100
another
level?
thing. Here's another thing too is the market can get ahead of itself. And positioning can get off sides. In the same way that people FOMO into, the latest meme coin, these derivatives traders and stir traders that are out there trading these markets, they can FOMO in too. it's
Of
a
course.
human psychology that can take place, and they may be offsides at least temporarily.
Cyclically, sure. Short term, sure.
Cyclically, short term, yes. Um, but the other thing is, and this is always important to remember, is that the currency game is a relative game.
Ah, there you go.
And so it's not a question of is the US going to devalue its currency? That is a given. The question is it going to devalue its currency faster than those around it?
That is
The
a valid
euro
point.
and the yen. And I am not sure of the answer to that. I do not have a crystal ball there, but I would say that relatively the US is in a much stronger position than either the euro or the yen, which are
So it
the
has to
the largest components of the
DXY.
DXY.
So it has to devalue less. All they have. So this is the opposite of the cycle. The U.S. has to tighten more, and now on the other side, they just need to devalue less to keep their currency advantage.
Yes,
Solid.
correct. And so we may have seen the devaluing that is going to take place here. However, they're issuing a lot of treasuries, as we saw by the deficit spending. And if you actually look at deficit spending, and hold on, I gotta find that. God, I have so many freaking things. Let's see, which one is the deficit spending? Where did I put it? I reorganized all this crap and now I can't remember where it is. That's the trade weighted dollar for those that care. While I hunt for the, let's see. Where did I put the deficit? It's up here somewhere. Oh, here it is. Here it is. Okay. This is current deficit spending. And so I actually drew these lines on here, which I think are interesting to note. And I drew them for a reason. Notice when deficit spending peaks. Do you see a pattern emerging here?
Are those recession lines?
The green lines are recessions, but the deficit spending always peaks when interest rates finally bottom. So, do you think we've bottomed here? I think not. So, I think we are far from the bottom. This looks like an unstable system that is reaching
resonance.
a harmonic resonance.
Harmonic,
Yes, exactly. It's harmonic resonance taking place, and it is spinning out of control. So I don't expect the deficit to bottom anytime soon.
That
It
means
will
dollar
bottom
supply go up.
right around the time that, well, at least dollar supply from money like assets issued and fiscal spending. So the real, it's funny because another one of these classic econ concepts is the idea of money velocity, and money velocity is just like this remainder that they didn't know how to fit it into their model, and so they just said that it must just be that money is changing hands faster. Not that we couldn't actually count the amount of money out there, because we have no way of knowing who is issuing dollar liabilities. No. It is simply that the money must just be moving faster.
Wouldn't that be interesting if I don't think they come to velocity? Clearly, that's private sector institutional deposits. I mean, what public sector, the U.S. government, and how much they're borrowing. I mean, the whole point of raising interest rates is to suppress demand for debt. And it accelerated in a rising interest rate environment. The monetary velocity, if it included the federal government, is through the roof.
Yeah, and it's funny because I don't even have velocity on here, and I'm not even gonna bother looking it up, but it probably is showing through the roof, because it is.
No, it's not.
The Fed has tried and failed many times to count the amount of dollars in the world. M1, M2, M3, but they eventually just decided that it was a Sisyphean task to try to actually count the amount of dollars. And so, yes, in the short term, you are going to see deficits explode. And you will notice that during the debates, like, there was little talk of the economy and
oh my God,
deficits.
zero.
And so here is the TGA sitting pretty right at about 750, where they've been holding it steady for quite some time. This dates back to October 23. So they've been just sitting on the TGA. So that hasn't moved. But the RRP New lows
Oof.
on the RRP. Now, earlier when we were talking about those bands, the SRF on the ceiling and the RRP on the bottom, as repo rates climb, this and as new bills and treasuries are issued, it forces repo rates up because there's now more collateral and less dollars. And so if you want to borrow against collateral, everybody's got collateral. What people don't have as much of is the dollars to lend against them. So those rates go up. So what happens is issuing of bills mechanically and money like, I mean, because the closer duration you are to cash, as you move out like 1 month, 3 month, or 13 week, 26 week, if you want to get technical, bills that are issued, those are more cash-like instruments, and they are safer to lend against because things are unlikely to move against you in an unpredictable way. And all you're relying on, much like a CDP stablecoin, you're relying on market liquidity, which, as you can see with the DXY plummeting down from down here all the way up here where liquidity was tight AF. Now we're down here. There's plenty of liquidity. And so as they issue that collateral, what's going to happen is mechanically it's going to suck dollars out of the RRP, which is basically a holding tank for excess dollars, where the Fed basically pays you staking points.
Fed Reserve staking.
Yeah, it's Federal
Why?
Reserve staking, and you're getting paid an interest rate of 5.3%. Well, that's about to go down, and it's about to go down to 5.05. And so when that happens, once again,
How are they going to not drain the RFP?
oh, they're gonna drain it. They're
It's
gonna
gonna
drain it
happen.
because as the deficit increases, this will get drained. And the problem is this acts as a very nice little buffer to keep you out of trouble. Because when we get into QE, that is because repo rates start hitting the high end of the ceiling, the standing repo facility. As the repo rates shoot above the ceiling, that is when market functioning starts to come into question.
What's a credit event?
Yeah.
I think a definition.
And so the buffer that we have, as long as this thing's full, you're not going to have a credit crisis. You're just not. Because you can extend and pretend that everything is fine. And the other thing that's happened here, and this is another thing I wanted to hit on today, which we have covered a lot of ground, is that there has been this trend, right? Credit, like, how do you measure credit, right? Historically, that's been done by way of HYG, and some of these other ETFs are a nice, easily visible. It's a visible spectrum sort of metric on what credit market functioning looks like. Notice what happens, when these start to blow out. December 2008, March of 2020.
There's no demand for it.
And look back here, June of 22. So that was when, yeah, well, everybody's selling off high yield for safer assets. Now, what's been interesting though is the issuance of private debt versus public debt. There has been a lot of private debt issued and not as much public debt in the last like few years. And that means that there's less supply for ETFs like HYG. And they're the ones buying it no matter the cost, because people want to buy these products or speculate on these products. And if you aren't issuing debt, if corporates, because the interest rates are so high, can get a better deal in private markets, they're going to go there. And so,
and clearly they're getting a better deal than tri-party.
Yeah. And so, or if they just want to play shell games with the amount of debt that they have and try to move it to places that are deeper into the shadows, just like China did with all of their debt. I think you are seeing the same thing with corporate debt, with commercial real estate debt. They're finding ways to extend and pretend with these debts so that they don't have to mark them to market. They're taking private equity funds and starting up new private equity funds that then buy up the debt of the old funds. And they're playing these little shell games that instead of forcing them to liquidate their assets and mark them to market, allow them to just kick the can down the road.
What was it called? Someone was said Texas two-step for doing that. You just spit off the bad debt.
Exactly. And that's basically what's been done, but it's been spit off into the private sector. And so I am of the belief that when the next crash does come, and it will, mark my words, it will, and not imminently, as I just said, the RRP's still got plenty of liquidity. And aside from the tri-party looking strange, I don't see any stress in the money markets currently, especially the dollar money market. So the next dollar crash, I don't believe is coming. So not yet anyway, like where you get the dollar going parabolic because everybody is scrambling for dollars. We're issuing way too much debt for that to happen. We still have money in the RRP. Money is being pulled forward. What's going to happen? I think the next crashes are coming overseas before they come here. That's kind of my macro thesis. And so and I continue to and I continue to see, like, keep an eye on these signposts because that is my macro thesis. But the point I want to make here is that classic indicators such as this are becoming less useful as money is pushed into the shadows. Because we live in such a managed market, like there is absolutely, I have no doubt in my mind that federal, state level entities or the Fed themselves are playing in markets to slam the VIX down.
I mean, look at that. How incredible is that? It's the biggest VIX explosion since 2020, and nothing happened.
Nothing happened. It was managed immediately. Now, some of that is everybody realized overnight that, hey, money markets are still functioning.
No, yeah. Why are they still? That's the whole point. Why are they still
Right.
functioning? Smooth market function.
Yeah, there is some of that, and there's some of it that people got scared real quick. VIX, everybody speculated on the VIX blowing up, and then everybody was like, "Wow, vol is really expensive here. I'm going to sell me some vol because historically, selling vol at these levels is a damn good deal."
I mean, it's just yes.
But
It's a managed environment.
it
Yeah,
is a very managed
was it
environment.
not
It's and
nihilistic? I'm
it's
cynical.
it's difficult to disentangle how much of this is people responding to the historical mark the reaction function of the powers that be and how much of this is just natural. Hey, look at this, I can sell VIX calls for extreme amounts of money right now. Ain't no way we're going to 100. And then a whole bunch of vol supply hits the market and it drops down. So, but the point is that these sorts of indicators that everybody looks at, these are the ones that are going to be useless when the next crash comes, because it's like Heisenberg's uncertainty principle. As soon as a tool becomes useful for measuring the state of the market, it becomes managed by
And the
those in
risk goes
charge,
somewhere else.
and the risk goes somewhere else, and you need to follow the risk to
There
where
is no
it.
coincidence that the SFIX came online in 2022. It's not literally a capacity for an entity to crush the VIX by
Yes,
buying. Oh my
yes.
God.
Look at this thing. Look at what this thing did. I mean,
How do you manage vol? You buy it.
yep. Or
Oh my
sell it.
God. Oh my,
Or
oh
sell
my
it.
God.
Mostly sell vol. You
Well, you
go,
buy the
there's not
SFIX
going
and
to
it
be.
facilitates. So
Yeah, you sell.
you can put capital into that instrument, and they're able to manage the creation of that vol to suppress it.
Yes. So yeah, these tools, while they're very useful to look at, um, they they are an indication of manipulation as much as they are an indication of something actually happening in the market. And the key takeaway here is that the game moves where the risk moves. So you need to be watching where the risk has moved. And to my mind, the risk has moved into private credit, private equity, places where things are no longer marked to market, places where the metrics and the data are not readily available, because in a world of information where everybody can look at this crap, people like me who don't pay for any special
Blooming.
data services have access to this data. um you know that is not going to be the place where the next blow up occurs. Now it may be visible if you've got a Bloomberg terminal and you have access to some of this private credit stuff. And who knows, maybe the next crisis there will be some data that starts screaming that something is awry, but I guarantee you it will be buried deeper in the macro data.
They swept Credit Suisse under the rug.
Yeah.
Swept it. They pulled the March of 2023 for Credit Suisse. Oh my dear. I'm
Yeah.
past cynical. So past cynical.
Yeah.
So
I
to
mean,
the point where the data, as you're saying, is irrelevant.
right. I mean, and it's funny because we look at these charts every day, but they do tell you information. They do tell you information because they try not to have to manage. They can't be everywhere at once managing markets. Um, and so they have to go where the problems lie. And you can see the problems begin to manifest and then they are quickly suppressed. But every time we have a crash, it is because there's an area of the market where the Fed does not reach. Their open market operations
What's
are
the acronym for the? What's the
FOMO.
acronym for that? Thank you. Thank you.
Yeah.
Just saying.
So the open market operations does not reach, and then they have to come out with the new tools or whatever, introduce some new facility every single time. They never have enough tools, enough visibility. They don't ever have enough regulations in order to stop market panics and crashes. And that's because it is a fruitless task. We will always find a way. Money will always find a way around your regulatory regime. It will find a way to position itself and overlever itself. And manias, panics, and crashes are as inevitable as the sun rising and the sun setting each day.
I mean, look at that
And
chart. Look how incredible that is with the Fed funds rate, where the dollar is. What do you think pulls it below the 200? Oh my God! It's. Uh, I'm stunned by this chart day in day out. It's gonna pull it right
so
through.
you can see right here, this is the moment at which the market decided inflation is taking hold and the Fed is going to have to raise rates. Right there. Right here, this is where the market decided, holy crap, the Fed needs to stop raising rates. And then they raised them some more.
That's right.
And then,
FOMO kicked in.
FOMO kicked in. They managed to squelch the volatility. They issued a bunch of treasuries. A lot of this had to do with the debt ceiling battle too. That was a lot of this too, because you cut off the supply of cash like instruments to feed the dollar system. And then the dollar, people need dollars and you're not issuing them. What's going on? That's why we have to run deficits, because if we stop issuing treasuries, this is what happens.
It blows
This is
up.
what
The whole
happens.
system blows up.
Yes,
That's
the
what
whole
people
system.
don't understand about the national debt. I mean, yes, it's gross, but yes, it's a demand. What's causing, aside from
Well,
uh, domestic,
you need dollars to run the economy, and you need dollars to run the global world economy. And so as dollars proliferated through the system, starting after World War One, as dollars proliferated all across the world and dollar denominated liabilities proliferated, you needed dollars to service those liabilities. And the really the national debt is not really a measure of, it's not only a measure of how much the US government owes, as much as it is a measure of how many dollars are needed to run the
how much
global
demand there is
economy.
for the dollar.
Yes. And the problem comes at the end when demand for the dollar starts to decrease, and now you need to find a way to suck those dollars back in. And the only way to do that is to pay off the debt.
We'll see that. We'll see that in the data real quick. We haven't seen that one yet.
Haven't seen it yet, and it ain't happening anytime soon. But that is, that is the macro.
That's the mechanical thing that we would see. I absolutely agree with that. Well said.
Excellent. Well, we've been at this for an hour and 40 minutes of pleasure. Let's go through real quick and make sure I didn't miss any questions. Let's see. Anon Unity also asked, would markets want to get ahead of the second rate cut by preempting the Fed? Absolutely. Selling early, making a higher profit. Yes. And you'll see this too. In the treasuries.
See it in the dollar.
Look at this. Look at this. Look at this. Look at this. So here's the 1 month, right? We've known that the Fed was about to cut. We've known that the Fed was about to cut for weeks and months. But the problem is, and that it was happening in September. But it wasn't until this week that right here, between the 19th and the 26th, the 19th. So when is the FOMC again? The 17th and 18th of September. It wasn't until 1 month beforehand that the 1 month starts to price in the 1 month rate cut. And so now it is sitting right at 5, which previously it was at 5 1/4. This tells you right here, anything other than a quarter basis point cut will be shocking to the markets. And the Fed ain't going to fight the market. Like, it's not that, in the same way that you don't want to fight the Fed doesn't want to fight the market either. Like, there's a sort of peace treaty between those two. And when the market doesn't read the way they want it to, they're going to leak information that is going to tell the market what it should believe when it comes to short-term interest rates. So 25 basis points, you can put your money on it. I that's not financial advice, but there's not a lot of arb left on that one, though.
I mean, that begs for a post on X. The tail wags the dog.
The tail does wag the dog. So, that being said, until next time, we're going to extend and we're going to pretend.
Most certainly.
And don't be exit liquidity.
It's the name of the game, ladies and gentlemen. Stay rational. Catch you soon.
Yep.